Goodwill is another important example of intangible asset. So what is a goodwill? Goodwill refers to an intangible asset of a business that is created from such favorable factors such as location, product quality, reputation, managerial skills, and other things that are hard to measure using like direct value. Generally accepted accounting principles, or GAAP, allow goodwill to be recorded only if it's objectively determined by a transaction. So in other words, you cannot create your own goodwill. Goodwill is only going to be included in the financial statements if you acquired another business that has its own goodwill. And in this case, you're going to put some price or some value on the goodwill acquired. But other than that, you cannot put a value on your own goodwill. That's not something that is acceptable by GAAP. So an example of such a transaction is the purchase of a business at a price in excess of the fair value of its net assets. The term net assets I want you to learn because it's a little bit tricky. Many people think net assets is just total assets, but actually net assets is total assets minus total liabilities. So the excess is recorded as goodwill and reported as an intangible asset. So that's how we put a price on the goodwill, or put a value on goodwill, only when there's a transaction where a business purchases another business. So unlike patents and copyrights, goodwill is not amortized. It used to be. In the good old days, it used to be amortized, but not anymore. Now it's only subject to something called impairment tests. So a loss should be recorded if the future prospects of the purchased firm become impaired. This loss would normally be disclosed in the other expense section of the income statement. So to see an example, assume that on December 31st, Face Card Company has determined that $250,000 of the goodwill created from the purchase of electronic systems is impaired. And electronic systems here is the name of a company. The entry to record the impairment would be as follows. We're going to debit loss from impairment goodwill, and we're going to credit goodwill. And we just have a very short note that says impaired goodwill. So you see, this is a form of an adjusting entry that's been recorded based on an impairment test. The good thing is at this level you don't need to worry about how the impairment tests work, but if you decide to major in accounting, then this is something that you're going to learn and see how the calculation for it works. So frequency of intangible assets disclosed for the top 500 firms in the United States. And here you can see that 435 firms, they had goodwill. Customer list, which is another form of intangible assets, is about 320 companies. Trademarks, brand names, and copyrights are about 302. Technology and software about 205, patents 134, franchises and license 73. So you can see goodwill is by far the common form of intangible assets. So this is just a summary of those intangible assets that we covered, and we also see a comparison. I think this would be helpful for you when you're doing this kind of final review. So a patent is an exclusive right to benefit from an innovation. Its estimated useful life not to exceed its legal life. And we said that the legal life is usually 20 years. And the periodic expense would be an amortization expense. What's a copyright? It's an exclusive right to benefit from a literary, artistic, or musical composition. Its estimated useful life not to exceed legal life. And again, the copyright here is a bit longer. It's 7 years beyond the life of the author or the authors. And then the periodic expense here is amortization expense. A trademark is an exclusive use of a name, term, or symbol. There's no amortization period. Impairment loss, if fair value less than carrying value, then we do an impairment. And again, remember, most trademarks, they have to get renewed every 10 years. Goodwill, it's the excessive purchase price of a business over the fair value of its net assets. And remember, net assets is the assets minus the liabilities. And I like to be more specific by saying it's total assets minus total liabilities. No amortization period, so we don't have an amortization period for that. And the impairment loss at fair value less carrying value. And in this case, we have to do an impairment. So again, I'm going to skip the checkup corner. I think it's easy. You can apply that on your own. And now let's see how the financial reporting for long-term assets. And we'll start with, actually we do both, fixed and intangible assets. So in the income statement, depreciation and amortization expense should be reported separately or disclosed in a note. So we don't combine them together. Depreciation is always separate from amortization. It's also separate from depletion. A description of the method used in computing depreciation should be also reported, and that's typically done in the footnotes or the disclosures. On the balance sheet, each class of fixed assets should be disclosed on the face of the statement or on the notes. The related accumulated depreciation should also be disclosed either by class or in total. The fixed asset may be shown at their book value, which is the cost minus the accumulated depreciation. Try to remember that. The book value would show like how much was the original price minus the accumulated depreciation. If there are many classes of fixed assets, a single amount may be presented in the balance sheet supported by a note with a separate listing, and usually the note is in the disclosures. And then also fixed assets may be reported under the more descriptive caption of property, plant, and equipment. And nowadays I see the term property, plant, and equipment is widely used among companies. Intangible assets are usually reported on the balance sheet in a separate section following fixed assets. So we always start with property, plant, and equipment and then the intangible assets. And then the balance of each class of intangible assets should be disclosed net of any amortization. So we'll see here an example for the company that we've been seeing before, which is Morning Joe. It's a cafe, and they have the balance sheet for December 31st, 2016. And you can see here they have their long-term asset, which is property, plant, and equipment. They have the land. And remember, land does not have any accumulated depreciation, so we use just the original cost. And then we have building with its original cost minus its accumulated depreciation to get its book value. Then we have office equipment, again minus its accumulated depreciation to get the office equipment book value. And then adding these three numbers, which is the net value for land, building, and office equipment, will give us total property, plant, and equipment book value, which is this value, the $4,328,000. And then after we're done with that, we have the intangible assets, and in this case we only have patents for a value of $140,000. The last part of this chapter is to go over some kind of analysis for decision making, and the ratio that we're going to be using today is something called fixed asset turnover ratio. It's a very good ratio. It just shows you how much sales you can generate based on your investment in the fixed assets in the company. So the fixed asset turnover ratio measures the number of sales dollars earned per dollar of fixed assets. I always think about fixed asset as an investment in a business. That's how you're investing in the business and how much sales you can generate out of that. So the fixed asset turnover ratio is computed as sales divided by average book value of the fixed assets. Whenever we see the word average, remember it's beginning plus ending divided by 2. We're never given the beginning in any financial statement. Beginning of this year is the ending of last year. So we go for, let's say we're 2020, we go for December 31st, 2019, and we add to it December 31st of 2020, add them together, divide them by 2, and that would be the average book value. The higher the ratio, the more efficient the company is using its fixed assets in generating sales. So in this case, we always prefer to have a higher turnover ratio. So let's see an example here. The following data in millions were taken from a recent financial statement of McDonald's Corporation. They have 28, let's say, $1 billion. I'm sure this is $1 billion value. Beginning of year fixed assets were 24.6 billion. End of year 25.7 billion. So to calculate the fixed asset turnover ratio, we get the sales, which is the 28,106, divided by the beginning fixed asset plus ending divided by 2. And if we do the math, it would turn out to be 1.1. I think this number is a little bit low compared to other companies based on the coming slide here. You can see that we are comparing businesses in the same industry. So we have McDonald's, we have Sonic, we have Jack in the Box, we have Wendy's, we have Yum Brands, and we have Chipotle. So you can see that Chipotle is the highest. It has 3.5 times. So it shows that for Chipotle, at least at the time these numbers were used, had the highest fixed asset turnover, which shows very high efficiency in using their fixed assets to generate sales. On the other side, McDonald's, they're on the other side of the spectrum. So you can see here, of course it varies, but the thing I want you to learn out of these kind of analyses is that you have to compare apples to apples and oranges to oranges. As you can see here, we've compared companies that are in the fast food business, and they're almost in the same industry where they sell burgers or some other kind of fast food, like Chipotle in this case. So that's how you can do it. You cannot compare McDonald's to Walmart or Ford or IBM or Google or Tesla. You can see all these companies are in different industries. You have to always compare companies in the same industry to get meaningful comparisons. Another comparison here, you can see that we have Disney. Again, this is different industries, so it's these ratios in various industries. You have Disney 2.0, ExxonMobil 1.7, Google 4.2, Macy's 3.5. Manpower, and you see here this is a temporary employment business. The ratio is very high because most probably they don't have a lot of fixed assets. McDonald's 1.1, and Union Pacific is even lower, which is a railroad. They have a huge investment in fixed assets, and that's why their fixed asset turnover ratio is 1.5. So by that, I conclude Chapter 9. Thank you for watching and listening, and I wish you all best of luck.